Many thanks for joining us. This is Business Morning on Channels Television. I am BC Adebayo. Now, crude oil futures surged today after U.S. President Donald Trump said he expected Saudi Arabia and Russia to reach a deal soon to end their oil price war. And Russian President Vladimir Putin also called for a solution to the challenging oil markets. Brent crude futures rose over 10% to about $27 a barrel in early trade, while U.S. crude futures were up 8.71% at $22.08 a barrel. Now, Mr. Trump says that he held talks recently with the leaders of both Russia and Saudi Arabia and believes that the two countries would make a deal to end their price war within a few, lowering production and bringing prices back up. Meanwhile, Russian President Vladimir Putin is calling on both oil producers and consumers to find a solution that would improve the challenging situation of global oil markets. Well, we have our eyes on the development. Of course, we'll continue to bring you updates as they unfold. And back home now, the Central Bank of Nigeria says a total of 15 billion naira has been generated so far by the private sector coalition against COVID-19. A breakdown of the relief fund received shows that 37 donors, including the CBN, banks, individuals, and other corporate bodies, donated various sums into an account domiciled with the financial market regulator. The CBN commends the coalition of individuals and corporate bodies for hearkening to its clarion call, which is jointly championed by the private sector and wants more support to overcome the COVID-19 pandemic in the country. Now, the first quarter of the year 2020 is one that most investors may not like to make reference to, except possibly for the purpose of bookkeeping, and that's because of the many challenges that have come up, especially with the issue of the COVID-19 pandemic. But despite the good and the bad, ugly side of the first 3 months of the year, we can't but take a look back at these events, perhaps in order to help you rethink your investment model for the second quarter of 2020. The head of portfolio management at Commercial Partners Asset Management, Victor Aluyi, joins us now for this conversation. Good morning, Victor. Now, tell us, how have the markets been able to handle the ugly situations in the first quarter, ranging from the coronavirus pandemic, which has led to lower oil price, of course, Nigeria's revenue challenge, and the disruption to the budget implementation?
Well, I think, like you rightly pointed out earlier, this is a quarter that a lot of investors would be willing to forget in a hurry. It's, been a very tumultuous quarter, exceedingly challenging. Funny enough, the quarter started out quite strong for the equities market. As a matter of fact, in January, the market returned over 7%. What we had seen in January was, we had some decent amount of liquidity flowing into the market at the time, and that basically supported broader market momentum. So we saw even PFAs, taking positions in the market at the time. So this essentially served to lift the markets in the month of January. But going into the month of February, we saw some, profit taking that essentially kicked in, basically leading to some sort of repricing. So what we had in the month of February was a decline of about 9%. But towards the end of February, as the whole COVID-19 situation, morphed from an endemic situation to a pandemic situation, the risk situation became significantly increased. So basically for Nigeria and for Nigerian markets, you essentially had a double whammy where, the COVID-19 situation created a demand destruction for crude oil prices. And then you had the situation where OPEC Plus and Saudi Arabia, so essentially Saudi Arabia and Russia, could not reach an agreement to essentially continue to prop up or support crude prices. Immediately that agreement or those discussions fell through, all bets were off. What you basically had was a significant decline in risk assets. Basically, the Nigerian market, equities market, basically fell off a cliff from there. And we have been bleeding ever since. Just for a bit of context, as at the end of Q1, the market had lost 20.5%. Again, market closed just slightly north of 21,000 points. For context, this is the lowest the market has come since 2005. It clearly, tells you how, rough and how tough things have been, and the negative investor sentiment that is out there right now. So that is what we've seen, so far in the market this quarter. The banking sector is down about 33%. The consumer sector is down over 40%. So across various sectors, the market is down strongly. And the major factor, the major driver essentially is the COVID-19 situation, which has led to, an essentially cessation of demand on crude oil. And then the supply situation, which has created a condition where the market is now seeming oversupplied because of the agreements between Russia and Saudi Arabia that did not pull through. So clearly tough times, for the markets in Q1. And, it really remains to be seen how things pan out from here on.
Now, talking about how things will pan out and, of course, looking at efforts to cushion the effects of the COVID-19 pandemic. Now, the CBN says that 15 billion naira has been deposited so far as donations from corporates to curb the spread of the virus. But how far can this impact any change?
So, like I said before, this crisis is not necessarily an economic crisis. It is a health issue or a health crisis that could potentially lead to an economic crisis. So what global central banks and global fiscal authorities are doing is a step in the right direction, but it would not necessarily take the problem away until we have a biological solution, until there is a solution, from the biological standpoint, until we begin to see, the cases of this spread start to peak and then drop off, or we see a vaccine or some sort of treatment. Those stimulus packages will only serve as a buffer. And what they are doing essentially is to say, you know what, we don't necessarily have an economic crisis, but once this blows over, we have enough buffers to ensure that the aftermath don't necessarily lead to an economic crisis. So I think that's the import of what the global monetary authorities are doing, and the import of what fiscal authorities are doing. So any fiscal measure right now is to essentially assuage the impact and also ensure that once this blows over, we don't necessarily tilt into an economic or a credit crisis globally and locally. So the impact right now, you really wouldn't feel it significantly. I think the impact will be felt more once this blows over.
But do you think that those donations will possibly challenge the portfolio of those donors, especially in the first quarter?
Sorry, take that again. I didn't get that.
I was asking if you think that these donations that have been made now by these bodies will in any way affect or impact the portfolio of the donors.
Well, not significantly, because these are, large and heavy corporates that are quite healthy and really, really profitable. So I don't think it would have any significant impact on their portfolio or their profitability or position whatsoever. I think it's a great thing that they've done, answering that clarion call, putting their money on the line to assuage the impact. Because at the end of the day, it is important that they also continue to operate in a decently sustainable environment. So yeah, I don't think it will have any significant impact on their positions or their portfolio.
So are you of the view now that the world is in a recession?
I don't. I think what we have, like I said before, is a situation where the global economy is hibernating. Before COVID-19, you would see that the global economy was, on a relatively strong path, particularly because at the beginning of the year, China and the United States had signed a phase one deal of the trade war that had raged for almost 2 years at the time, which was essentially the elephant in the room for the global economy. Once that was done, we started to see, significant improvements in the global outlook. So with COVID-19, what you have seen is essentially, a hibernation or a cessation of global demand. It's not necessarily a case where demand had come off or demand has dropped, from a normal economic cycle. It's a case where the global economy right now is hibernating. The sort of recovery that you're going to see obviously would depend on how long this hibernation lasts. So if the COVID-19 crisis rages on for a little while longer into maybe Q2, Q3 of this year, obviously the recovery would certainly take longer. I don't characterize this as an economic recession. I'll rather characterize this as an economic hibernation that we're seeing right now. Once, the biological challenge blows over, once we pass the eye of the storm, I believe that, we're going to see a decent recovery. However, that would depend on how long, the COVID-19 challenge lasts. If it lasts significantly longer than it is already, then the recovery could be a lot slower than we anticipate. But if it blows away by Q2, for instance, I think we're going to have a decent recovery.
All right, now it's good that you've talked about looking ahead now, because I was just going to ask you what the second quarter perhaps will hold for the world, Africa, and Nigeria in particular.
So for Nigeria, the second quarter really, it still all hinges on how things pan out with, the whole COVID-19 situation. Also, how things pan out on the crude oil fronts. For instance, if we see, cooler heads prevailing, that is, Russia and Saudi Arabia deciding to come to the table either at the instance of the president of the U.S. or at their own instance coming to try and see how they could support energy markets. Yeah, that could be positive. But again, I think the bigger issue is the sort of progress that we make or that we see on the COVID-19 front. I want to believe that, the new epicenter of the crisis right now is the United States. Cases are rising quite significantly. So we're probably maybe another fortnight away from cases peaking. If those cases start to peak in the U.S. and then start to drop off in the U.S. and also in Western Europe, we could see the situation being significantly controlled through Q2. And if that happens and then energy markets also recover and the global economy starts to recover, you would see markets also recover because, again, you already have an unprecedented amount of stimulus in the global economy. So once the biological challenge blows over, you are going to see a decent recovery in Q2. Again, if the crisis lingers beyond Q2 or continues to linger throughout Q2, and then a recovery will really be off the cards, and the challenge will just continue to wear on, and it will basically be safety and from where I see things. So clearly, Q2 is basically dependent on the kind of progress that we see on the COVID-19 front, and also what happens in terms of an agreement to maybe support the energy markets. If that happens, then we could see some decent traction. In the absence of that, things can probably get a little worse from where we are right now.
Well, you mentioned stimulus packages right now. Now, will those stimulus packages around the world and locally suffice in cushioning the effects of the pandemic on the markets?
So, like I said, the truth of the matter is that if you look at the impact of those stimulus right now, what you are seeing is, knee-jerk reactions, in the markets to those stimulus packages as they have been announced. The impacts will certainly not be lived as long as the COVID-19 challenge remains. Like I've said, what global monetary authorities and fiscal authorities are doing is to provide a buffer for when this situation blows over or a situation where this crisis does not lead to an economic or a credit crisis. Again, this is not necessarily an economic crisis. It's a biological or a health crisis that threatens to lead to a significant economic crisis. So those economic stimulus or packages are there to ensure that by the time we get to a situation where we're staring down the barrel of an economic crisis, we have buffers in place that can help assuage the potential impact. So you might not be able to assess that impact right now. A better assessment of the impact will come once we see significant improvements on the biological front. Nevertheless, they are great moves, and they would technically serve to assuage the impact of the crisis going forward.
From your research and perhaps as part of conversations among fellow financial analysts now, have you learned about any convincing developments that could end this war?
Well, there have been a lot of talks about a vaccine. We've had indications about a vaccine that is probably 18 months down the road. We have had indications of a vaccine in the works, in Israel. I mean, there are all kinds of indications as to a cure. We've heard about the use of, chloroquine to treat, the ailment. So all kinds of things, really. It's difficult to see what that progress has been, really. I'm sure that once there's any significant progress on that front, we will get the information, and that would help really calm nerves and, assuage, negative sentiments that we're seeing in overriding markets right now.
Head of Portfolio Management at Commercial Partners Asset Management, Victor Ali, thanks for sharing your thoughts with us this morning.
Thanks for having me.
Now let's do a review of the local equities markets, and Edidiong Ewang is ready to do that for us. Good morning, Eddie. So the downturn at the equities market continued yesterday with the all-share index touching a new 8-year low. Of course, these are not happy times for investors, right?
Good morning, BC. You're right. These are not happy times. As a matter of fact, some of us had our fingers crossed, hoping to hear April Fools yesterday, but unfortunately, that was not the case. The Nigerian market dipped further into the bear territory as the all-share index fell by 0.94%, to 21,100.54 points, bringing the year-to-date loss to minus 21.4%. The equity cap was lower at 10.996 trillion naira. Yes, BC, we've gotten to the 10 trillion naira level, and this is from an initial high of 15.1 trillion naira as of January. Investor sell-offs on bellwethers like Dangote Cement and Zenith Bank were responsible for the drag in the market yesterday. The total volume of trades decreased by 63.4% to 154.55 million units, while value increased by 2.5%, I beg your pardon, to 1.76 billion naira, and all those were traded in 3,415 deals. Now, market sentiment as measured by market breadth was negative as 26 stocks led by Unilever lost, while there were only 6 gainers, with MTN Nigeria and International Breweries recording the largest gains of the day. Sectoral performance remained negative. 3 counters declined, insurance gained marginally, while oil and gas remained unchanged, BC. Now, for the banking index, that was down by almost 2% as losses were recorded from 9 lenders, including all the Tier 1 banks, while the others were unchanged. Consumer goods declined 1.22% as Unilever lost 10%, Guinness was down 9.92%, and Flour Mill shared 9.88%. Of course, the loss on the industrial goods counter was as a result of the 9.95% decline from Dangote Cement yesterday. So we see that insurance was up 0.08%, while oil and gas remained unchanged. For the fixed income markets, the bond market witnessed minimal activity in Wednesday's trading session as we saw mixed sentiment across the different maturities, although with minimal volumes traded as yields closed relatively unchanged. The average yield contracted by 5 basis points to 11.8%. Across the curve now, yields contracted at the short, mid, and long segment of the curve, following buying interest in the July 21 maturity and the February 2028 bonds. In all, we saw about 12 deals worth 6.10 billion naira. The Nigerian Treasury bills market, was also... It remained subdued with the bulk of the attention focused on the primary market auction. So because of that, rates remained a little unchanged to end the session. Unmet demand at the auction is expected to filter into the secondary market today. Average yield across instruments contracted by 6 basis points to 3.6%. Now, across the curve, yields contracted at the mid-segment following demand from the 121-day to maturity instrument, while the short and long ends were flat. We saw just about 8 deals yesterday in that segment of the market worth 108.57 million naira. At Wednesday's primary market auction, BC, the CBN fully allotted 96.68 billion naira worth of bills at respective stop rates of 2.20%, 3.20%, and 4.30%. Now, BC, I would like to note that these rates were lower than the previous rates allotted. Similarly, the average yield contracted by 51 basis points to 14.5% in the almost secondary market. There are only 67 deals worth 299.24 billion naira, BC.
Didier, in spite of all the challenges and all the disappointing numbers, we'll continue to hope for a profitable market trading day. Many thanks, Eddie.
You're welcome.
And when we return in just a moment, we'll take a closer look at remote trading on Market Street. You stay with us.